Hello everyone, welcome to the 155th episode of me learning how to trade in Forex. So in the last episode we went through how to work out your risk profile. Basically your risk profile is a measure of how much risk you can take on and how willing you are to accept those risks. So your risk profile isn't solely determined by your age. So while age can certainly be a contributing factor, there are several other things that affect your risk profile. So these include where you choose to invest your capital and how much of it you're willing to risk. And then we look through the importance of risk profiles. So knowing your risk profile could help you determine how you access the markets, from the products you trade to the stocks you invest in and everything in between. So consider your financial goal, whether it's a short-term goal or a long-term goal. And with that in mind, we looked at 3 ways you can make money from the market and which risk profile they may suit best. So for the low risk, we got the interest, basically savings account and stuff like that. Low risk, not that much chance of you losing your money, but equally the return of that is very little. It also carries a risk of your value of your investment steadily lose buying power over time. Then we've got dividends, medium risk. So dividends are a portion of a company's profit that gets returned to the shareholders. So however, the main issue of that is dividends are issued at the company's discretion and are often tied to company's quarterly performance. So that means they can be reduced or not paid out at all. And then we've got the price movement, which is high risk. Basically, buy an asset like a share, you're hoping to sell it later at a higher price than when you paid. So this is what price movement is. And then when you buy an asset that's increasing in value, you make a profit. However, there's no guarantee that the assets you choose will appreciate. So if the asset decreases in value, however, you lose money. So and then if you open a leverage position in the market, you could buy or sell or short sell different financial assets, and taking leverage positions in the market is one of the highest or the biggest risks you can take with your money. So it's possible to use a blend of interest, dividends and price movement to get a bit of high risk, medium risk and low risk, everything in there into your portfolio. And then we've got the risk profile for every need. So different person can have many different risk profiles at once based on their goals. Combining risk profiles will be dictated by what you need your different investments to do. And we looked at the 3 risk profiles, so low, medium and high risk profiles. Low risk profile is generally going to consist of savings accounts and bonds, because you don't want to take that much risk. And then we got medium risk. So portfolio for medium risk could include individual shares or even collective investments like ETFs, investment portfolios and interest-bearing products. And we've got high risk. So high risk, you want to try trade products with high liquidity as well as build an investment portfolio. Could add derivative products such as CFDs and other leverage products. So however, remember, for the high risk, the money you set aside for high risk portfolio should always be money you can afford to lose. I know we went through the lesson summary. So now we're on to understanding leverage. Understanding leverage. Date is the 3rd. So understanding leverage. Leverage is a powerful trading tool and a key feature of several derivative products. Think of it this way: when you buy a new car, you may not be able to pay the full amount right away. Often you can choose to make a deposit and pay the rest off in your installments. Once the initial deposit has been paid, you can take possession of the vehicle and drive it around. Trading using leverage works somewhat similarly. You only need a small initial outlay to get greater exposure to the underlying market you're trading. In trading, this deposit is called your margin. And this diagram is very nice, as always, by IG. So copy H. Let me just do that. do that. So you only need to deposit a small amount of capital margin to control to get greater exposure. So leverage to get greater exposure to the markets. Okay, so exposure, capital required if it's unleveraged, basically the same or exactly the same. With leverage position, you only need a small amount of capital to get the same, I guess, big exposure to the market. In essence, your trading provider is lending you the difference between your margin and the actual cost of buying into the market. Even though you only pay a fraction of your trade's total value up front, you'll be exposed to the market based on the size of the full position. Just like when you pay a deposit on a car, you can drive out with it as if you owned it. This means that using it could increase your potential profits, however it can also amplify your losses. Even though you only pay a fraction of your trade's total value up front, you'll be exposed to the market based on the size of the full position. This means using leverage could increase your potential profit. However, it can also amplify your losses. This lesson will cover how leverage works in different situations and how it may affect each product you choose to use. Example of leveraged products. You can take a leveraged position using a variety of derivative products, from simple spot trades all the way to complex options. Did you know derivatives are financial instruments that traders use to speculate on the possible price movements of an asset without owning the asset itself? These products derive their value from the price of the underlying asset instead and allow traders to take a position whether the price is going up or down. Instead of outright owning the stock, derivatives acts as a contract between two parties and can be traded on exchange or over the counter. Forex, commodities, indices, shares and bonds are just some of the asset classes you can trade with these. You can take a leveraged position using a variety of derivative products. So, using a variety of derivative products, from simple spot trades all the way to complex options. Derivative products are financial instruments that traders use to speculate on the possible price movements of an asset without owning the asset itself. So these products derive their value from the price of the underlying asset instead and allow traders to take a position whether the price is going up or down. Take a position, take an up/down position. take a going up/down position. Instead of outright owning the stock, derivatives acts as a contract between two parties and can be traded on exchange or over the counter. Derivatives acts as a contract between two parties and can be traded on an exchange or over the counter. Forex, commodities, indices, shares and bonds are just some of the asset classes you can trade with these. So, you can take a leverage position using a variety of derivative products from simple spot trades all the way to complex options. Remember, spot trading involves taking a position at the current market rate or spot price. Spot trading involves taking a position at the current market price or spot price. These trades don't have fixed expiry dates, but they do incur overnight funding charges. That's why they could be used for short-term trading, but not well suited for medium and long-term strategies. The real-time prices closely track the underlying market. So, spot trading don't have fixed expiry dates. However, they do incur overnight funding charges. That's why they could be used for short-term trading, but not well suited for medium and long-term strategies. Therefore, spot trading is good for short-term trading, but not suitable for medium/long-term trading. The real-time prices closely track the underlying market. Okay, so a more complicated way to trade using options. These financial instruments act as contracts, giving you the right but not the obligation to trade a particular asset at a set price and on a set date in the future. Giving you the right, but you don't. So you can do it, but you don't have to trade a particular asset at a set price on a set date in the future. It costs a small premium, but you don't have to complete the trade. So options trading involves so acts as a contract which gives you the right but not the obligation to trade a particular asset at a set price and on a set date in the future. Costs a small premium, but you don't have to complete the trade. Options trading has a small premium, but you don't have to complete the trade. Futures contracts acts as agreement between two parties to exchange an underlying markets at a set price in the future. So, futures contract acts as an agreement two parties to exchange an underlying market at a set price in the future. These products also use leverage to increase your exposure to the market. Unlike an option, here the buyer and seller are obliged to complete the purchase or sale before or on the expiry date, so you have to do it. The buyer and seller are obliged to complete the purchase or sale before or on the expiry date. CFDs and spread bets are also leveraged. They too follow the underlying market's movements very closely because their prices are derived from it. Like other derivatives, the price you pay to trade a CFD on a particular market seeks to mirror any price movements on the assets of the asset itself. So later in this course, we'll delve deeper into all the different products, leveraged and non-leveraged, that we offer so that you can decide what's the best for you. When using leverage works for you. As mentioned, leverage amplifies your exposure to a market, which means your profits and losses can be exponentially higher. Let's see how that actually works. Say you have £10,000 that you want to try and grow in the markets. You do your research and predict that stock XYZ PLC's price will rise soon. You have two options: buy the shares outright at their full value or trade on the market using a leveraged derivative instrument. In a non-leveraged trade, you simply put £10,000 worth of XYZ PLC shares. If the share price went up 10% and you sold them, you'd have £11,000, ignoring any commission and other charges. Your profit would only be 10% of your initial capital, which is the same increase that the asset also experienced. So initial outlay, your profit is 10% of that. But what would happen if you instead to choose using a financial instrument that gives you a leverage and has a 20% margin requirement? The same £10,000 means you can now take a position worth £50,000, and your provider having lent you the £40,000 difference, because £10,000, I was going to say, is 20% of £50,000, but it's not. Oh no, it is, because 20% is a fifth of 100%. So, and £10,000 is a fifth of 50, and £10,000 is a fifth of 50,000. So yeah, okay, yeah. If you're right about the asset's price rising, the value will increase by the same 10%. The initial £50,000 position will now be worth £55,000. Remember, you only put down £10,000 for the trade and you've made £5,000 profit. That's a 50% return on your initial outlay. This is leverage at work. So you pretty much, what is it? Yeah, made half, 50% return. Using the above example as a basis, let's calculate what would happen if the margin requirement was 10% instead. If your initial outlay was 10,000, how much would your position be worth, and what would your profit be if the share value still increased 10%? The margin requirement was 10%. So if 10,000 was only 10%, so 10,000 times by 10 to get 100%. 100% of the position is £100,000. And if it only still increased by 10%, what's 10% of 100,000? 10,000. So £100,000 with a profit of 10,000. With a 10% margin requirement, your initial outlay of 10,000 would mean you'd take a position worth 100,000. When the share price increases by 10,000, your position will be worth 110,000. Oh, because you add that £10,000 on. Oh, right, okay. This means that you have earned a profit of £10,000. So you basically doubled your moolah, which is very nice. When leverage works against you, like with any stock market activity, there's no guarantee you'll make a profit. When you have a losing trade, leverage can magnify the negative effects as well. Let's consider the downsides. Using the above example, let's see what would happen if you invest in XYZ PLC and its stock price depreciated. Had the shares from the XYZ PLC dropped by 10%, your £10,000 investment will now be worth £9,000. If you think the share price might increase in the long run, you could keep the position open. If you anticipate that it will never recover, you might want to close the trade to avoid losing any more of your money. With this method, you only realize that loss once you sell the shares. Had you made a trade using the same leveraged financial instrument as before and the market depreciated by 10,000, the loss will be magnified. Your full position in the market will be worth £45,000. That doesn't seem so bad until remember you put down £10,000 with a 20% leverage, effectively entering a £50,000 trade. Your total loss will be £5,000, which is half the original capital you put up. Even though you only paid a fraction of the total value of your position, you're liable for the full loss. Using the above leverage example again, let's calculate what it would take you to lose the value of your entire investment if your trade required 20% margin. If you had originally put up 10,000, how much would the share price need to drop for you to lose your initial outlay? 20% margin, so how much would the share price for your initial outlay? Your initial outlay is 10,000, isn't it? It will be 20, won't it? Because so the full position is worth 50,000. If the share price dropped by 20%, 50,000 is 10,000, and that's how much you originally put up, so 20%. Your total value of your shares would have to drop to 40,000 to lose your initial investment £10,000. The new value of your shares is now only worth 80% of the position you took, meaning that the share price would have fallen by 20%. So 20% on your account is donezo. Whoa. The worst case scenario when using leverage. When you trade with leverage products, you could lose more money than you started with. Can you guess how that's possible? This is what would happen if, instead of a 10% fall, your position dropped by 25%. Your initial leverage trade of 50,000 will now be worth only 37,500, and the loss will be equal to 12,500. Remember, you put up £10,000 of your account's funds. You've lost 2,500 more than the money you put in, and you need to have enough funds in your account to cover that loss. Luckily, before you close your entire account with equity, the losing position will trigger a margin call. Typically, this means that you'll be notified by a trading provider or broker if your position is losing money rapidly and the equity in your account is about to run out. So, margin call. You'll be notified by your trading provider or broker if your position is losing money rapidly and the equity in your account is about to run out. This signals that you need to close your positions because you'll soon fail to meet the margin requirements to keep it open. If you don't, your provider might also begin closing them for you to reduce the strain on your funds. So this signals that you need to close your positions because you'll soon fail to meet the margin requirement to keep it open. Margin requirement to keep it open. If you don't, your provider might also begin closing them for you to reduce the strain on your funds. If you don't, your provider will close them for you. In the UK, negative balance protection prevents your losses from going beyond the funds you have on your accounts. This means that if the losses on your trades take you beyond zero, your trading provider is legally required to bring it back to zero, at no cost to you. It's likely your position will be closed before this happens. So this means that if the losses of your trades take you beyond zero, your trading provider is legally required to bring it back to zero, at no cost to you. It's likely your position will be closed before this can happen. As a retail client, this applies to all your trades. However, if you're a professional client, this may not always be the case. Negative balance protection. Okay, that's nice. You can try to avoid falling into this unpredictable territory with risk management tools. Stops, especially guarantee stops, can help you prevent losing more than you can afford to. While normal stop loss orders are free, your position can experience slippage. Stop losses and guaranteed stops can help you prevent losing more than you can afford to. However, stop losses can experience slippage. However, your positions can experience slippage when using stop losses. Slippage is when the market moves against you in times of high volatility, extreme volatility, not high, extreme. Prices may move faster than it takes to process your order. The prices may move faster than it takes to process your order. Your trading provider or broker may be unable to close your position at the original price you set because it's no longer available. Therefore, your trading provider or broker may be unable to close your position at the original price you set because it's no longer available. Using guarantee stops, on the other hand, incurs a charge when a stop is triggered. This is because you're paying to ensure that a position is closed at the exact price requested. Your provider takes on the risk that slippage might occur. Guaranteed stops incurs a charge when a stop is triggered. So when you're just starting out, losses like these can be disheartening. Managing your actions and emotions when it happens is an important part of the psychology of trading. Therefore, trading with leverage requires discipline and know-how. Experience and planning may help you prevent a trade from getting so bad that you lose more than you started with. For instance, you'd be better prepared to use stop loss orders to set the maximum loss you're willing to incur from a trade. Sometimes markets become so volatile that even careful preparation isn't enough, so it's important to use leverage with caution. The costs of leverage trading. In the earlier example, you essentially borrowed money from a broker to open your leverage trade. As in all financial situations, borrowing money carries a cost. Some products will charge you to hold your positions open after market hours. In this event, your trading provider will make an interest adjustment to your account, reflecting the cost of funding your positions overnight. This is why leveraged products like CFDs and spread bets can be better suited to short-term trades. Holding them for prolonged periods of time could end up costing a fair bit of money, reducing your potential profits. Some products will charge you to hold your positions open after market hours. In this event, your trading provider will make an interest adjustment to your account, reflecting the cost of funding your positions overnight. This is why leverage products like CFDs and spread bets can be better suited for short-term trades. So leveraged products are better suited for short-term trades. Not all leverage products, maybe. Leverage like CFDs and spread bets are better suited for short-term trades. Holding them for a prolonged period of time could end up costing a fair bit of money, reducing your potential profits. There are other products like futures or forwards, but they don't incur overnight funding charges at all because of how they're structured. Instead, they have a wider spread, a difference between the buy and sell price quoted for an asset, which has a cost of overnight funding built in. So other products such as futures or forwards don't incur overnight funding charges at all, as they have a wider spread, which is difference between the buy and sell price quoted for an asset, which has the cost of overnight funding built in. Here are some other costs you can incur. So other costs you can incur. Commissions. When you trade stocks using CFDs or when you invest in them. When you trade stocks using CFDs or when you invest in them. Borrowing fees. When you short a stock using CFDs. When you short a stock using CFDs. Currency conversions. Well, when you trade in a currency other than your own. So you go convert your currency to the currency you're trading. Extra services, e.g. live price data fees and third-party charts. Extra features offered by your trading provider, e.g. live price data charts or third-party charts. Live price data feeds, not charts. The difference charges will also depend on who you choose as your broker or trading provider and how they structure their product offering. You don't need leverage to be a successful trader. Without leverage, traders can buy the underlying market without any loan component. Yes, this may reduce profits, but it may also reduce risks, including losing more money than you put up to open the trade. Don't need leverage to be a successful trader. Not using leverage means not using leverage may reduce profits, but also reduces risks, including losing more money than you put up to open the trade. For a trader starting out, avoiding leverage altogether might be a good idea. Yep, so for a beginner trader, avoiding leverage is a good idea. No way, so a beginner trader should avoid using leverage. Avoiding leverage altogether might be a good idea. There will be enough to learn and manage without the added risks. You may also want to practice using a risk-free demo account to get a feel for what trading in the market is like. Yep. Practice using a risk-free demo account to get a feel for what trading in the market is like. To get a feel of what trading the markets is like. As you get more confident, you could choose to add it to your strategy. When you do decide to use leverage, you may want to consider how much you're taking on board. A margin requirement of only 10% sounds great if you're in a winning trade, but you could quickly wipe out your account balance if the market moves against you. If leverage is used, consider how much you're taking on board. Consider how much leverage to use, i.e. margin requirements of 10% sounds good. Only if you're in a winning trade. However, you could quickly wipe your account balance if the markets move against you. Whatever you decide, remember what you've already learned in this course. You can use your risk profile and your preferred trading investing style to guide your choices. Whatever you decide, remember what you've already learned in this course. You can use your risk profile and your preferred trading and investing style to guide your choices. Yep, okay. So, lesson summary. Leverage is how some traders increase their exposure to a market without increasing their initial investment. How some traders increase their exposure to the market without increasing their initial investment. While using this strategy can increase your potential profits, it also magnifies any losses you might experience. So, yep, done that. You can lose more than you initially invested if the market moves against you significantly, unless there are risk management tools in place. You could lose more than you initially invested if the market moves against you significantly, unless there are risk management tools in place. There are different leverage products that you can use to trade, but their costs, leverage and margin requirements vary. But the costs, leverage and margin requirements may vary. While leverage is a useful tool, you don't need it to become a successful trader. Yep. So remember that you don't need leverage to become a successful trader. wrote it again, but okay. Cool. Well, I'm going to leave this episode here then. So, another long lesson, but, you know, it was good. So, in the next video, we're going to go through the complexities of trading. So, thank you all for watching, and I will see you guys in the next video. Bye bye.